What's going on, guys? It is the Zoomer Value Investor here to talk to you guys today about kind of like some macro trends I've been noticing in the markets. I think we're in a really unique environment here in the markets right now because we've seen a pretty significant bull rally here, and it's really hard to tell the setup. When you have a Fed kind of being a little bit more dovish, a Fed also lowering the percentages by which he is hiking every FOMC meeting. And when you're seeing that dovish behavior from the Fed, you're just kind of seeing a lot more bulls jumping in. And after, the kind of like pseudo recession we went through in 2022, this significant bounce back, it's just a lot for investors to take in right now. So with that being said, here at the Zoomer Value Investor channel, I really kind of want to talk to you guys today about what I'm kind of looking to do with my portfolio in an environment such as this. And I'm really hoping that you guys can maybe like draw some lessons out of it. So I'm just going to kind of explain to you guys right now. So this is my current portfolio at this time. This is my public YouTube portfolio. I have mentioned it before, but obviously, yes, I do hold other private accounts, which does constitute a majority of my holdings, but I do rest assured you that these companies you are seeing here do constitute a majority of my holdings, like a significant percentage. So I'm heavily invested in these companies, and I'm just starting to pull plays in this environment. And no, I'm not talking about buying stocks. I was actually a huge buyer in stocks pretty much all of 2022. Especially towards that curtail end in like October. But for me, ladies and gentlemen, in this environment, I've actually been a little bit of a seller here of stocks. Yes, a seller of stocks. Now let me explain. To some degree, as a value investor, there are always buys out there, but what it comes down to is like kind of more or less what you want to do with your capital. So if you have a ton of cash on hand and you don't have a lot of working capital at that time, working capital being capital that you have invested, then you're in a different scenario than me, because I'm kind of more somewhere like 20% cash, 15% cash. You know what I'm saying? Like I'm not heavy cash at this time. I didn't just like stumble upon an inheritance at this specific moment in my life. Like I don't have any of those scenarios going on at this time. Anything like that where I have just a ton of cash and I'm looking to do something with it. Now, if you are in that scenario, one of the benefits of being a value investor is that yes, there are always buys out there in the market. And I have been buying some stocks, but in this environment where the fear and greed index is flashing towards very greedy, not only that, also in an environment where, after you've been a buyer of stocks and you've been just getting pummeled every time you bought in the stock, it seems like it just goes down and goes down. And after you've been in that environment for so long, once you come into an environment where it seems like every time you buy a stock, it can just only go up. Ladies and gentlemen, when you're in that type of environment, that's the time to kind of like reach into your investor psychology a bit and ask yourself, there's actually greed in my portfolio for the first time in maybe like years, a year or whatever, 1 to 2 years. And people process information like one of two ways. They'll see that and they'll go, I'm a genius, I'm a brilliant investor, all this green in my portfolio. I knew it all bounced back. I'm amazing. Let's buy more. Let's get some leverage out, take some leverage out. We're gonna buy more. And ladies and gentlemen, it gets crazy, it gets hectic. And the other way that you can interpret this is, there's a good amount of greed in my portfolio here. I was a net buyer of stocks for a long period of time. I was a net buyer of stocks to the point where I only had like 5% so of cash, or maybe I spent all my cash. So I'm kind of a liquid because I was that much of a buyer, but now it's finally come back. I'm looking at it, it's unrealized right now. I don't know, I could leave it in, there could be a lot more gains here, but I need to become liquid again. I need to get some cash back. I need to rethink, what sectors I want to reinvest into. And then, ladies and gentlemen, those people on the second end, they're a little bit more fearful when other people are greedy. And that's what I kind of believe is more important now than ever in a market environment where a lot of investors have piled into these markets in the last couple of years, myself included. And I'm going to be like straight up honest with that. I'm part of that, and that's why I boldly do claim the Zoomer Value Investor title here, because I'm very adamant about. I had to read a lot of books. I had to, learn a lot from a lot of different investors like Lee Lu, Charlie Munger, Warren Buffett, Howard Marks, Peter Lynch, Guy Spier. Like, I'm pulling lessons from all these different people. I'm reading all these different books. I've gone over the spiel of all the different books I like to read. But it's almost like, I feel like in a way I've almost like earned that kind of psychology, that kind of like that second way of thinking, because it's almost against like the human innate psychology of things, and the way like humans process risks and reward and stuff like that. And I feel like the stock market kind of preys on that in a way. So for the layman person, for your average hardworking person, it's really hard to get a grasp on something like the stock market, because they may never, ever even get to that depth of the iceberg where they even learn about like the psychology that goes into things like this. An example would be, you could play poker and you could never, ever like learn about the depth that goes into watching professional poker players. I think another great example is you could pick up a game like Super Smash Brothers and you will be like, oh, this game is fun and easy to play, but you will never, ever perhaps learn the depths to which that game can actually be played and to which someone could run circles around you. Super Smash Brothers could always just be this game that's just played at the party, and that's all you ever know about it. It's all it's ever like processed in your existence. You don't ever learn about just the kind of like deeper layers of the iceberg. And I feel like that's kind of how like is with investing. And you never want to go too deep down the iceberg, right? I feel like there's a good middle ground there between simplicity and depth. And I feel like Peter Lynch really kind of like preaches that in his books a lot too, where it's like, don't overcomplicate this, 15 to 20 holdings, quality companies that you understand, go do it. And then it's like, he's not out here going crazy about things. He's not here trying to buy 100 different stocks, trying to be like perfect capital allocators, putting together perfect portfolios or whatever. I'm going to do my job. I'm going to do it in a human way that, yes, might be volatile, but I know it will work, and it will work in the long term. And I have good research and good gut to back that up. Boom, my money on the table, let's do it. Backpacking off that spiel on value investing I just gave, I really just want to bring up how the Zoomers and the, I believe they're calling them Generation Alpha, like the generation below us in age. Like, they're the ones most at risk of just being unaware of the depths of the iceberg that you need to do well. For example, they just don't have the time on earth to have gotten through this stuff. For example, Warren Buffett has a lot more time on earth to have uncovered the depths and the layers of the investment iceberg, compared to the people you see on Wall Street Bets or the Robinhood penny stock subreddits. So I think that's something to be really important and cognizant of. And I know for me, when I look at something like the 10,000 hour rule or something like that, it was just really important to me in the last 4 years or so. I'm nailing that 10,000 hour rule when it comes to this investment thing, because I just know I'm just gonna have to put my time in at some point. Why not just do it earlier in life? So ladies and gentlemen, the point is that just acknowledging your weaknesses, I think, is really important if you are a younger investor, and just really trying to get those out of your system, man. Just try to just learn, hit the books, and rehearse, study, and progress, and I'm very imperfect. I'm still learning myself, and that's why I like being here with you guys, the viewers, to check me on things. So yeah, ladies and gentlemen, my plan for the portfolio. I've been a seller of stocks. I've sold a good amount of my applied materials position, AMAT. I will eventually sell it off in entirety. My fair value was around $110 for this company, and it's actually pushing above that point now. So yeah, I definitely just have to start selling it and just look at better risk reward elsewhere. PayPal, I've been trying to scale out of PayPal. Essentially what happened with PayPal was, since I bought it, just the company and the way they were moving, and they were getting invested in politics and things of that nature, I just don't really appreciate as a shareholder. I just would really appreciate if they kind of remain more of a neutral profit-based business. You know what I'm saying? Just kind of not like a faceless corporate entity, but not politically agenda'd. You know what I'm saying? And kind of and there's news about their CEO stepping down and stuff like that. Not stepping down, but just retirement. things like that. So just kind of like been going through some stuff, and I've been looking at that position. I'm pretty much like break even or maybe like a small gain on it. I think when I was selling some shares like at around $9 for a small gain, but at this point now it's like averaging out. I'm averaging out of that stock, and kind of like, you know, just selling it at like break even at this point. But been incredibly happy with this portfolio's performance over the last from the year-to-date perspective. This portfolio has done very well. I am enthused by this, and I explained how I put this portfolio together in other videos. I guess I could maybe like link them in the description, but I think it's just really cool. Maybe if you want to like see kind of like from day one how I put this together and how I kind of like planned it out. But yeah, now that I'm kind of like cashing up here with this portfolio was actually fully invested. This portfolio was taking a beating, and it was vastly underperforming SPY at a point in October of 2022. It was right after big tech earnings week. And I remember what had happened was my portfolio was taking so much of a beating where I was in the point where I was like, all right, I have to do it. I have to add funds. So I added 33% funds to the portfolio. So it's now a $1,300 portfolio or so. And as you can see here, it's well in the green, and that discipline to buy the dip was definitely needed at that point in time for the portfolio. Again, like I said, just, you know, taking your money, putting it on the table, saying, hey, let's see what happens, you know, because either I was buying the wrong stuff and I was going to be more wrong, or I was right and I just kind of had to have a stomach for volatility and just kind of like see things through. And we're still kind of at that point, we're still seeing things through, still seeing where things can go. So now that I have all this cash and that a lot of my underperforming assets are starting to pick back up, really seen Meta pick back up here. Meta's just absolutely gone on a tear recently. And a lot of my other tech names have picked back up here too. And actually, as you can see, I'm actually very overweight tech, and a lot of that had to do with buying the dip. For some investors, they have different risk thresholds. I'm a higher risk threshold investor. I don't mind over concentrating in a sector sometimes if I know that that sector should rebound very quickly, very soon, as well as I know that there are several underpriced assets in that sector that are profitable, cash flow generating businesses. And that's what it was for tech for me. You know, when I look at like Amazon, Meta, Google, you know, Applied Materials at the time for like $80, $90 a share, you know, all these names in big tech, and it's just like, man, it just looked like no brainers, you know, at some of the prices they got down to. I remember Meta at 88, Google at 82, Amazon in the 80s, I believe, maybe even like a high 70s at one point. But now that just a little bit of that is behind us, unfortunately, you know, with these bull runs do come the fear and greed index. And I just do believe that personally, with a very greedy fear and greed index and just kind of like some things I've been seeing with the macro trends and whatnot, one thing I really want to point out here is that the moving averages are bullish. They are pretty overall bullish on the indexes. Generally, the SPY is the one I generally like to be focal toward. And what you see here is you see like the 200 moving day average has become like neutral bullish. Like it's not in that downward trend anymore. And then obviously, like, you know, you have your 25 and your 50 is kind of trending bullish again. Obviously, we had a choppy week here. This past week has been a little choppy, but you know, SPY at like 410, 409, whatever it's at today. I mean, wow. I mean, that's just so much different when it was 360, 380 for so long, you know? So yeah, it was good to just cash up, take some stuff off the table. But what I personally like to do here with stuff in an uptrend still is I'm just rebalancing the portfolio. So I'm just kind of deconcentrating from tech a bit, selling off a little bit of my tech names, and I'm going to buy some stuff in different industries. Now, the stocks I've really been adding are, if you look at my last video, I talk about some of them. I did buy a few shares of Paramount in my personal account. I would definitely add that to the YouTube portfolio if it comes down to a certain price. So, you know, selling off these tech stocks, what am I looking to like buy? I just want to rebalance, right? Because I still want to own stock assets if the stock market's in this like crazy bull run, but maybe I want to own like less risky stock assets. So I've really been looking at some. One thing I think looks really good is Hasbro here. Hasbro, huge gaming company, owns like Magic the Gathering, the like Transformers figures. all these different IPs. I mean, the Parker brothers who own like the Monopoly, they own so many different IPs, man. And I was looking at them, I was like, whoa, they're only like they were like a 6.8 billion market cap or something like that. I was like, that seems really cheap. Looked into their financials, cash flow generation. I was liking what I was seeing. More specifically, like just their ability to work with like gaming and software seems pretty impressive from what I could see. They have like this online Wizards game that's kind of like printing cash right now. Like what the heck? I like where the business is at here at this valuation. I feel like I'm buying the business at like a very, very historically opportune time. There's a good amount of like backlash from fans about them kind of being like a bit of a gripe when it comes to the games, the dealer to fan relations with the games. And normally that stuff like rebalances at some point. It normally like gets really bad and then it gets really good and it gets really bad. Unfortunately, these gaming companies do, like some of them do like to just kind of like gripe, like I was saying, just kind of like, do microtransactions, try to get at the fans with little bits of like low efforts here and there to save money, cut costs, or maybe what they'll do is just kind of overcharge the fans for like an expansion or something like that. Or do a pay-to-win kind of model. Gaming fans hate this. They hate this when they do any of those aforementioned stuff I mentioned. But what I said though is it's cyclical. I've seen this all the time. Like you look at EA, they'll do something like they'll release a Star Wars Battlefront. Everyone will hate it. Everyone will be like, what the heck is this? This is horrible. This is glitchy, the netcode is horrible, I can't even like play the video game without lagging out of the game. This system is pay to win. You have like pay to win perk system for the multiplayer competitive matches. Like, fans are like losing their mind at Electronic Arts EA over the game. And then, discourse happens. The game devs watch the player base fluctuate. They see that player base drop. Then the devs get on the Reddit forums and stuff, and then that discourse really starts happening. And then what you see basically is, the game gets fixed or something, or like a new title comes out that fixes a lot of those issues, and then that player base picks back up, and then that cash generation starts for that company again, yada yada yada. So that's what I'm saying. It is cyclical. Is that the gamers eventually will move with their feet on things. And that is kind of what we have been seeing here on Hasbro, but it's like, it's just like, I mean, do I see Magic the Gathering going anywhere? I don't even play Magic, but like, do I see Monopoly going anywhere? I don't even play Monopoly. No. So, I mean, it really is that simple. So that's why I think Hasbro here is really just a very simple, easy buy. A lot of the risk, I believe, is priced in. And that's the thing, like, you're not going to get a lot of opportunities where the company trades at like a stark discount to its cash flow generation, its return on income, and at the same time, the company is just in this like pristine reputation. You know what I'm saying? There's normally like a caveat when it comes to value investing that you have to be willing to run into. Like I was buying Meta during a time when people were talking about Meta has no cash, they burn it all in the metaverse, this useless project. Everyone's just like focusing on the negatives, and I'm sitting there like, what do you mean Meta has no cash? Because I go on the official like FDIC regulated information of the company. I can clearly see like in the financial documents, the three financial documents: balance sheet, income statement, cash flow statement. Like I can clearly see that Meta has cash. They're holding cash. Like. And then they announce this crazy $40 billion stock buyback, and I see everyone talking about like, where did they get the cash for that? Were they burning all in the metaverse? It's like, oh my goodness. If you looked at some of the information that's out there, you'd see that that was not the case. And that's the thing though, there's always a caveat. It's hard to say, right? Because that $40 or so billion stock buyback that Meta announced, I mean, it could have been like a 60, 70, 80, whatever billion dollar stock buyback if they didn't want to do this whole metaverse project. However, that's, like I said, that's a caveat, is I, as a shareholder, just have to stomach that knowledge that Meta burned all the billions of dollars that they burned on the metaverse, and I'll never know if those dollars will bear fruit until years from now. I'll never know. until maybe years from now, and if I'm even still in the stock. So when you're buying a business, you just got to consider like everything about it. And when I look at Hasbro, this rep, like I said, like this gamer rep stuff, it's cyclical. At the end of the day, they own the IP. They're powerful. They're gonna have to like find some kind of agreement, and so they can do business and they continue to thrive. And yeah, I mean, at the end of the day, like to run a good gaming business, you got to make good games. That's fundamental, right? So that's why you see like Parker Brothers and Monopoly, new kinds of Monopoly still coming out. They're still figuring out new ways to get that thing printing money. There's a lot of like, they're doing a lot of online gaming with stuff like Monopoly now, like online Monopoly. I've seen stuff like that's been getting a lot more popular. But yeah, that's the thing though, is I'm just saying that there is an upside to things. Like I'm kind of like looking at the upsides, buying the business. I am aware of the downsides. I am aware of the news that is out there that is on the con side of things, but I try to price that into my model, and then I act accordingly. And currently what I believe is the better move for me going forward here is to average out some of my higher flying tech stocks, PayPal, Applied Materials, and I'm gonna put that cash to work in a company highly likely like Hasbro. Already have a good amount of shares in my personal accounts on that one, so probably will see it in the YouTube portfolio here soon. And yeah, I'm just really happy to update you guys on the portfolio as well. Really happy to see this kind of performance. I know that our inception date of the portfolio was April 22nd of 2022, so we are creeping on the 1 year of our little gauntlet here, our little run. So we're gonna see how that goes. Definitely gonna do a video. That'll be in Q2, so it'll be a good time to do a video on the portfolio again. I hope you guys enjoyed. Please leave a like if you made it this far into the video, or a comment. A comment would be even better if you ask me. So yeah, Joe, I appreciate your time. Thank you so much for tuning in. Please let me know if there's anything on your mind when it comes to investing. I'd love to hear it. Thanks. Peace.